We provide bold,
legal insight and business leadership
to forward-thinking people and organizations.
We believe in better
and bold outcomes
and meticulous focus
in finding the solutions others might miss.
By building our practice around the best minds in the legal profession.
And outside of it too. We believe the pursuit of better starts with people.
Our colleagues, our clients,
and the people who depend on them.
We are committed to truly understanding
the individual needs
of those who depend on us,
so we can help them go from where they are
to where they want to be.
We are.
We are.
We are.
We are.
We are.
Husch Blackwell.
Husch Blackwell.
Husch Blackwell.
We are Husch Blackwell.
Good afternoon, everyone. I'm Chris Ham, an attorney in Husch Blackwell's Energy and Natural Resources Group. I practice in the areas of mergers and acquisitions and tax, specifically providing guidance for business transactions with clients across multiple industries, including energy. Welcome to today's webinar on state and federal tax credits, abatements, and traps. Before we begin, I would like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, it will be answered later via email. A PDF presentation is available in the resources folder. This program has been approved for legal education credit, and to report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Toward the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. So that's all for the housekeeping items, and let's get started with our program. Joining me today are Doug Jones and Bob Romashko. Doug is a recognized tax attorney and advisor who counsels businesses on complex tax structures and guides nonprofits on tax exemption. Doug's deep experience in tax law includes practical strategies for clients regarding mergers, acquisitions, joint ventures, workouts, recapitalizations, divestitures, spinoffs, entity formations, as well as all forms of capital raising activities. Bob knows taxing authorities and government agency investigations inside and out. He spent 6 years as a senior attorney with the IRS Office of Chief Counsel, and he deeply understands the world of federal and state taxes and helps clients with state and local franchise, income, sales, use, and property tax issues, as well as dealing with multi-state voluntary disclosures for taxes owed. And with that being said, we'll begin our program and kick it to Doug.
Thank you very much, Chris. Welcome, everyone. I am going to be the first of our presenters, and what I am going to be presenting are on the federal income tax incentives for renewable energy. The federal income tax law provides certain incentives for renewable energy, wind, solar, and other assets. The main ones, which you may have heard of before, are the investment tax credit, or the ITC, and the production tax credit, the PTC. But there are also things such as 100% bonus depreciation and 5-year maker's depreciation deduction, which is an accelerated depreciation deduction schedule. These incentives provide economic subsidies to certain investors looking to make investments in wind and solar electric generation property. These incentives are non-refundable tax benefits. So that means the incentives may only be realized by a taxpayer that would otherwise owe federal income tax and can benefit from these tax benefits. Since certain investors in wind or solar projects may not benefit from the tax incentives, various structures have been created to monetize the federal income tax benefits. Generally, tax benefits are available to owners. So that's why tax equity structures with tax equity investors have been developed, because people who can, the tax equity investors, take advantage of the credits, become an owner in a structure, and then can take advantage of the tax benefits. Now, first we'll focus on the investment tax credit. Section 48, A2 generally provides for a 30% investment tax credit on the adjusted basis of qualified energy property. So it's a credit based on the basis of the property that's put into service. This is most commonly used for solar assets. It is subject to a couple things that people should be aware of, such as recapture investing. The credit vests over 5 years. So this means that if the taxpayer disposes of the property within 5 years of being placed in service, the taxpayer must recapture all or a portion of the credit. This vests 20% per year. So if you get through 1 year of ownership, the recapture would be 80%. If you get through 2 years, 60%, and on you go. If a partner's interest in a partnership drops by more than 1/3, the partners must recapture the ITC. The partners must recapture the ITC based upon the proportion decrease. In addition to that, there is a basis reduction that is required with respect to property that gets placed into service. The taxpayer must reduce the basis of the asset that gets placed into service by 50% of the ITC. And in addition, it's good to remember that a certain property is ineligible for the ITC. This would include property used outside of the U.S., and it would also include property used by a tax-exempt organization, a government unit, or a foreign person. Section 45A generally provides the PTC based upon electricity production at a qualified facility. This is the production tax credit we're moving on to now. It's most commonly used for wind assets. The PTC is generally about 1.5, but can be as much as 2.5 cents per kilowatt hour of electricity produced by the taxpayer, if it is from a qualified energy source, and if it is sold by the taxpayer to an unrelated person. The credit is inflation adjusted, and it also depends on, the credit that you get depends on when construction begins in the project, and we'll get into that a little bit, but that's why we have a range of the values here from 1.5 to 2.5. The credit is available during the 10-year period beginning on the date the facility is originally placed in service. A quick note about, you're going to hear me using the terms beginning of construction and placed in service quite a lot in this section of the presentation. We're going to come back to those concepts and spend a good bit of time digging into them because they're very important, and we'll get to those. Now, in addition, the qualified facility with respect to a wind facility means that the facility must be owned by the taxpayer, that it's placed in service after December 31st, 1999, and that the construction of the facility must begin before January 1 of 2020. So in addition, the ITC, there are phaseouts, which we are going to discuss in the next slide. ITC phaseouts for solar facilities. The 30% ITC applies only to property whose construction begins before January 1, 2024. And by the way, this is under current law. There are some new proposals, which Chris is going to discuss later. But otherwise, if you don't qualify for the 30%, you have a default ITC of 10%. The 30% ITC is also subject to a phase-out. The ITC is reduced to 26% for solar property on which construction begins after the end of 2019 and before the beginning of 2023. And it is reduced further to 22% for solar property on which construction begins after the end of 2022, but before the start of 2024. To get the ITC in excess of 10%, the solar property must be placed in service before January 1, 2026. In addition, wind facilities are also subject to phase-outs. Now, wind facilities may elect to claim the ITC in lieu of the PTC if construction begins before January 1, 2022. and it's placed in service after 2008. The 30% ITC or the PTC, whichever it is, for a wind facility is going to get phased out in accordance with the schedule below. It drops to 80%, 60, then 40, and then back up to 60, depending on when construction began. I'm getting some, seeing some notices about it's hard to hear, so I'm going to take my headphones off and try just speaking directly into my phone, if y'all just bear with me for a second. Okay, hopefully this will be better. So moving on. Apologies for the bad connection there. So beginning construction. So this is an important concept used to determine how much ITC or PTC for which a project qualifies. There's two alternative tests for when construction begins, and these are provided by the IRS in notices that were released between 2013 and all the way up to 2021. The first test is physical work of a significant nature. So this is satisfied if there has been an actual construction of the project of a significant nature. This only includes work on a portion of the facility that will assist in the generation of electricity. Significant nature test for beginning of construction. There's also a safe harbor. So the physical work of significant nature test is a facts and circumstances test. You have to look at all the facts and circumstances and kind of determine whether or not it has been achieved. The safe harbor is different. It's just a 5% safe harbor based on, so the 5% safe harbor is satisfied if the taxpayer spends an amount equal to 5% of the total cost of the qualified energy generating facility. Here, facility is defined to only include property integral to the production of electricity. Thus, the cost does not include any land cost or any property that is not integral to the facility. Now, in addition to the two tests, those notices also establish a requirement that after you begin construction, you have to continue to do so. This is the continuity requirement. So you have to keep going. You can't just start a project, let it sit for 7 years, and then pick it up. You need to keep going. And there are tests related to whether or not you have met the continuity requirement. So the continuity safe harbor will be deemed satisfied with respect to a project that began construction in 2016 through 2019. So that's, again, that's beginning construction in 2016 through 2019. You have 6 years. This is true regardless of whether the construction was deemed to begin under the physical work test or the 5% safe harbor. So for example, if you start in 2019, you have until the end of 2025. In 2020, the construction needs to be complete within 5 years in order to achieve the safe harbor. This again is true regardless of whether it's the physical work test or the 5% safe harbor that established the beginning of construction. And if it's 2021 or after, you're down to 4 years. Now, these two, the 2016 through 2019 and 2020 6-year and 5-year periods respectively were established relatively recently in Notice 2021-41, which I believe came out in the end of June. And that's because of COVID. The IRS acknowledged that COVID is slowing things down and gave people more time to satisfy the continuity safe harbor. So in addition, Notice 2021-41 also did a couple other things. If the continuity safe harbor does not apply, so this is the safe harbor for the continuity requirement, there are facts and circumstances that you can fall back, facts and circumstances tests that you can fall back on if you don't meet the safe harbor. Under previous guidance, before this 2021 notice, if a taxpayer relied upon the physical work test to begin construction, the taxpayer is required to satisfy the continuity requirement through the so-called continuous construction test,
which is just what it sounds. You have to keep performing. If you start construction, you need to keep construction activities going. If, however, you relied on the 5% safe harbor test, you could rely on the continuous efforts test, which was a bit broader. As long as you were continuing efforts to move the project towards completion, and even if those efforts weren't necessarily construction, such as permitting or something like that, you could still satisfy the continuous efforts test with those non-construction efforts. Under the current guidance in 2021, however, the IRS tells us that the continuity safe harbor is not met. The taxpayer can satisfy the continuity requirement with either the construction test or the efforts test, regardless of whether you started construction under the physical work test or the 5% safe harbor. In addition, there are some excusable disruptions to continuous construction and continuous efforts that if there are disruptions that are effectively beyond the taxpayer's control, they will be excused, and then the existence of those disruptions won't blow up the continuous construction or continuous efforts test. Examples include severe weather, permitting, public safety, interconnection delays, manufacturing delays, labor shortages, stoppages, really anything that's beyond the control of the taxpayer. And there is one exception to this rule. If the Department of Defense tells you that they have a significant national security concern related to your project and tell you that you need to change your plan, any delays caused by changes in the plan due to that significant national security concern will actually toll the safe harbor period. The other two, the safe harbor period doesn't toll, but for purposes of the facts and circumstances tests, the disruption is excused. So we talked about beginning of construction. Now we can talk about placed in service. So this occurs. This is a concept that's been in the tax law for a very long time. It relates to the depreciation area, and the idea is that once you place an asset in service, you can begin to depreciate it. The sort of definitional test here is that placed in service occurs when an asset is placed in a condition or state of readiness for a specifically designed function. Again, this is a facts and circumstances test, but factors will include receipt of all licenses and permits, passage of control of the facility to the relevant taxpayer, completion of any critical tests relating to the safety and functionality of the facility, commencement of daily or regular operations, and synchronization of the facility into a power grid so that it can generate electricity and start producing income. Now, a couple notes here just kind of on tax equity due diligence and how these concepts related to beginning of construction can be sort of, you can show to your tax equity investors that, beginning of construction happened at a certain time, and the sort of documents that you're going to need to keep track of in order to do this. So with respect to the physical work of a significant nature test, physical work of a significant nature includes property integral to the production of electricity. So any significant work will satisfy this physical work test. There's no minimum percentage. The only requirement is that the work be significant and that it be on property integral to the production of electricity. Physical work does not include property used for electrical transmission or preliminary activities with regard to design, planning, developing, and financing the facility. Physical work of a significant nature includes work performed by the taxpayer and work performed for the taxpayer by another person under a binding written contract that is entered into prior to the manufacture or production of the property. Physical work may also be performed at a site different from the project site. Facility components are designed specifically for the project. So the best practice is to maintain contracts for purchase, information related to construction or development of the project, including pictures with dates, and invoices, payments, affidavits, and progress reports. The idea being you're going to need to prove to the tax equity investor when construction began, and those documents will help you do that. Now, with respect to the 5% safe harbor, the developer has to estimate the project's total cost, determine which project costs qualify as facility costs, and then ensure that such facility costs equal or exceed 5% of the total project costs. Facility here is defined only to include property integral to the production of electricity. It doesn't include land costs or other property not integral to the production of electricity. Best practice is to maintain, again, contracts, invoices, payments, affidavits, master contracts, and assignment agreements associated with the project. Now, a note on cash and accrual basis accounting methods. So cash is method is very familiar to everyone. It's just that when you write a check for an expense, that is the time at which the expense occurs, and that's the time you kind of put it on the books. Accrual is different. Accrual doesn't necessarily relate to the time of payment. In order to determine when a liability has accrued, there's two tests you have to look at. You have to meet the all events test and the economic performance test. A liability is incurred or accrued when all events have occurred that establish the fact of the liability, and that the amount of the liability can be determined with reasonable accuracy, and that economic performance has occurred with respect to the liability. Economic performance occurs generally when the services or property are provided to the taxpayer. There is a 3.5-month rule, which gives taxpayers a little bit of grace here, and taxpayer is permitted to treat services or property as provided to the taxpayer when the taxpayer pays for the service or property, if the taxpayer can reasonably expect the person to provide the services or property with 3.5 months from the date of payment. And property is generally considered to be provided when it's delivered or accepted or when title passes. And that is what I have to talk about. We can now turn things over to Chris.
Thanks, Doug. So my portion of it will be discussing the proposed PTC and the ITC extension. So in Subtitle G of the latest Budget Reconciliation Bill proposal from the House Ways and Means Committee proposes extending federal tax credits for wind, solar, and certain other clean energy technologies for 10 years, and giving the solar industry the option to use production tax credits long available to wind generators in place of the solar investment tax credit. So while imposing some new conditions, the bill also will meet the renewable energy industry's main goal of preventing a near-term phase-out of the PTC and the ITC. The proposed bill also bolsters the financing that is needed for a lot of the new solar and wind generation that must be installed to meet President Biden's goal of a carbon-free U.S. grid by 2035, also what's been stuck into what is called the Green New Deal. So for the extension of the PTC and the ITC, the baseline, the base credit rate is equal to 20% of the bonus rate, and the bonus rate is an increased rate for projects which meet certain prevailing wage and apprenticeship requirements, which I'll discuss soon after this. And so for the incentives that phase down in 2032 and 2033, the rate applies proportionally to the base credit rate and the bonus credit rate. So with our first requirement, the Department of Labor has defined the prevailing wage rate as the average wage paid similarly to similarly employed workers in a specific occupation in the area of the intended employment. For purposes of this, we're talking about the construction of the facilities. So to also claim the bonus rate, the taxpayer must ensure that any of its laborers and mechanics that are employed by its contractors and subcontractors are paid prevailing wages during the 10-year credit period of the construction of a project and any alterations and repairs of such project after it is placed into service. So there is a penalty for non-compliant taxpayers, but it can be satisfied and remedied if the taxpayer compensates each worker the difference between the wages paid and the prevailing wage that it should have paid, plus interest, and in addition paying $5,000 penalty to the Treasury for each worker paid below the prevailing wage during a taxable year. And so this penalty can also last for multiple years based on one's compliance. So our second requirement will be our apprenticeship requirements. So in order to claim the bonus rate, the taxpayer must ensure that no fewer than the applicable percentage of total labor hours are performed by qualified apprentices during construction. So the applicable percentage is 5% for projects in which construction begins in 2022. The rate is increased to 10% in 2023 and 15% thereafter. So with contractors and subcontractors who employ 4 or more individuals to perform the construction of these projects, they must employ at least 1 qualified apprentice to perform the work in the construction. Again, there's a penalty as well for non-compliance, but it can be remedied, and the taxpayer may satisfy it by paying a penalty to the Treasury equal to $500 multiplied by the total labor hours for which the requirement is not satisfied. But there is an out. So if there is a lack of available qualified apprentices with respect to construction of the project, there is an exemption process for which taxpayers may be deemed as having made a good faith effort to hire qualified apprentices. Good faith effort was not defined, so we'll leave it at that. So there's one more requirement, which is our domestic content requirements, which qualify for our facilities. So to claim the bonus rate for the facility for which a tax credit is claimed, the taxpayer must ensure that the facility is composed of steel, iron, or products manufactured in the United States. So a manufactured product shall be deemed to have been manufactured in the United States if not less than 55% of the total cost of components of the product is attributable to components which are mined, produced, or manufactured in the United States. So with our extension of the production tax credit, it allows the energy producers to claim a credit based on electricity produced from renewable energy resources with the base credit rate of 0.5 cents per kilowatt hour and a bonus credit rate of 2.5 cents per kilowatt hour. So in order to claim the credit at the bonus rate, taxpayers must satisfy the prevailing wage and the apprenticeship requirement. So for any projects that commence construction before this bill will be enacted or have a maximum net output of less than 1 megawatt will be eligible for the bonus rate. And so the base and bonus credit rates phase down to 80% of their index value for facilities which commence construction in 2032, and then 60% in 2033, and then no credit is allowed for 2034 and after. So the following facilities, for the following facilities, the PTC has been extended through the end of 2031 and then phasing down to 80% in 2032 and 60% in 2033. And some of these facilities are landfill gas and trash, qualified hydropower facilities, marine and hydrokinetic renewable energy facilities, and geothermal facilities. So more specifically, the tax credit that for wind facilities is increased to the full 100% credit rate through the end of 2031, and then it phases down to 80% in 2032 and 60% in 2033. For solar energy facilities, the credit is revived and it has been extended to 2031 as well, and with the same phase out as the wind energy facility. The caveat with the solar energies is that the taxpayers can claim not only the PTC, but the Section 48 ITC as well. So taxpayers can also claim an increased credit for the facilities that are placed into service after December 31st, 2021, if they meet the domestic content requirements. And they are provided for a base credit increase of 2% or a bonus credit increase of 10%. And these values, these credit rate increases, are not subject to any phase downs in 2032 and 2033. So moving on to our ITCs. So the extension of the ITCs allow taxpayers to claim a credit for the cost of qualified energy property with a base credit rate of 6% of the qualified energy property's basis, or a bonus credit rate of 30% of the property's basis. So it does have phase downs as well, and so it'll phase down to 5.2% for facilities that commence construction in 2032 and 4.4% in 2033. The bonus credit rate phase down to 26% in 2032 and 22% in 2033. So just like the PTC, the prevailing wage and the apprenticeship requirements must be met. And also like the PTC, if it commences before, construction commences before this bill is enacted, or has a maximum net output less than 1 megawatt, will be eligible for the bonus rate. So I mentioned that they could claim both the PTC and the ITC. So the ITC for solar energy property, again, is extended, and it has a base credit rate of 6% and bonus credit rate of 30% through the end of 2031. And those new rates phase down in 2032 and 2033 to a 2% base rate or bonus rate of 10%. For geothermal energy property, the ITC will mimic the solar energy property credit phase-out rates and timeline. And again, projects that commence construction before the date of this bill being enacted or have a maximum output of less than 1 megawatt are also eligible for the bonus rate. So the proposal also extended the ITC with the same rates as above in the solar energy facilities for fiber optic solar equipment, fuel cell and micro turbine property, combined heat and power property, small wind energy and offshore wind properties, and biogas and waste energy recovery property. And so no credit in these facilities will be allowed if it commences construction after 2033 or not placed into service before 2036. Also, there are a new set of newly eligible energy storage technologies, and they have the same base and bonus rates as the facilities just discussed. And so I won't run down this entire description of each technology, but I'll give you the guidelines. So we have energy storage technology, linear generators, microgrid controllers, dynamic glass or electrochromic glass, and biogas property. So for these facilities, taxpayers may claim an increased credit rate for the facilities placed into service after December 31st, 2021, if the facilities also meet the domestic content requirements. And again, no credit is allowed for any of this newly eligible property if construction commences after 2033 or not placed into service before 2036. And for another point in the proposal that I found quite interesting was the elective payments. So for energy property and electricity produced from certain renewable resources, the extension allows taxpayers to elect to be treated as having made their tax payment equal to the value of the credit that they will receive under the following credits. There are a list of credits that were in the proposal, but we are only covering Section 48 and 45 PTC. Section 48 ITC and Section 45 PTC, but there's a list below that are also in the proposal, just not covering those today. But the strategy here is, instead of carrying our credits forward, our taxpayers can request a refund for deemed payment of tax upon completion of the construction of the project, and this will allow the entities with little or no tax liability to use their credits. And finally, for facilities placed into service after the date of this bill is enacted, for which a credit is allowed under Section 48 ITC and Section 45 PTC or Section 48, the transmission credit, the amount of payment allowed will be equal to the amount of credit multiplied by its applicable percentage. And so for the elective payment, its applicable percentage is 100% for facilities which satisfy the domestic content requirements and the maximum net output of less than 1 megawatt. And so the applicable percentage for the elective payment is 100% for facilities which commence construction before 2024 and then phases down to 90% in 2024, 85% in 2025, and then is at 0 at 2026 and thereafter. And so that concludes my overview of the proposal that was just released a couple weeks ago. And so I will kick it over to Bob.
Thank you, Chris. And just a couple of brief housekeeping matters. First, I know there were some audio problems earlier. If anyone is still experiencing those, please let us know in the chat so that we, correct them as we switch speakers. Second, you should all be seeing a green thumbs up icon on your screens periodically. We did that in lieu of polling, but I guess the response rate is fairly low, and we want to make sure people are clicking so that they receive credit for states that require pulse checks, which is what our software calls those. We opted for those over asking you poll questions because we surveyed the presenters and none of us are big fans of those in CLEs. So getting into my presentation on state and local taxes, I think it's helpful to provide you guys a little background on, what I've experienced in this practice. I think that the reason for that is it'll help you understand what the real challenge of state and local tax on these renewable energy projects really is. My experience is generally that state and local tax does not drive the projects, rather, federal tax credits do, demand does, and obviously, given that most renewable projects are wind and solar, geography obviously does as well. And once you account for all of those facts, you've generally got a site or at least a region picked out, and it's a matter of trying to maximize state and local tax benefits within those parameters. But generally, what state you're in is sort of a secondary concern to what the actual, who the customers are, where's the demand, and where can we actually generate power. And so that's the first point I wanted to make, which is that, on some level, I feel like we phrase this as challenges and opportunities, but realistically, people need to be aware of the challenges, and the opportunities are about minimizing tax within the parameters you're working in on the state side. The second point I wanted to make as sort of an overview is, I think my bio is presented by Chris, mentioned that I started out at the Internal Revenue Service, obviously on the federal side. My involvement in these projects on the state and local side came about, first as a member of teams handling just income tax issues, because that's what I did federally, and then later expanding that role to cover property tax and sales tax and generally other specialty taxes. And, you know, when I started out on these projects, you know, you would go through, and frequently a lot of these projects were buyer side diligence. And so you'd write similar diligence memos on every deal. And of course, attorneys being attorneys, we would start recycling language about what the law was and what the, you know, applicable taxes were. And lo and behold, I found myself doing that probably about 2 years after I first started working on some of these projects, and discovered the law had changed and I had missed it. Nothing serious, nothing severe, nothing that changed the bottom line or anything like that. But where I'm going with this is, my experience is, and I think this is true, it is impossible as a state tax practitioner, as someone who specializes in it, to have constant current knowledge of all 50 states, even on a particular subject area. It's especially hard in light of the fact that with renewable energy in particular, a lot of the specialty taxes or credits or exemptions, have sunsets written into the statutes, and so periodically need to be renewed or not. Even the ones that don't, there's you know, constant changes to the law. To give you an example, Illinois, which is the state I'm originally from, although I live in Washington state these days, has a franchise tax that applies to corporations based on their paid-in capital. It's actually a huge tax trap for corporations, less so for LLCs and partnerships. But Illinois phased it out and then reinstated it earlier this year as part of a budget proposal. So unless you're keeping your eyes up on all 50 states and sort of doing a constant running 50-state survey, your knowledge is always stale by the time you look to apply it. And where I'm going with that is that there's really no substitute for doing the research, unfortunately, on pretty much every project, unless you're doing two in the same state, in the same year, in sometimes in the same county. So I was hesitant to lay out a bunch of rules that could be presented as hard and fast rules because, frankly, you always need to check the state and local matters on these deals. There's just no avoiding it. So what I wanted to present instead is sort of an overview, issue spotting. I know a lot of people involved are not tax specialists, and that's okay. But you know, these are the areas of concern. These are what you need to look at, and here are some of the types of opportunities you might find to minimize tax within that framework. So that said, I want to cover just briefly the different types of taxes that might apply. There's franchise and income tax, sales and use, property tax, transfer tax, which I actually did not put together a separate slide on, but we'll talk about with property tax. And some states have some specialty taxes that apply to electric generation or renewable energy generation, and we'll talk about that as well. So first, franchise income tax. So income tax is generally what you would think of as income tax on the federal side as well. I've included this map from the Tax Foundation. I would not spend a lot of time worrying about those rates, but I think it's useful to compare the states that are colored in and the states that aren't. The states that aren't are states that do not have corporate income taxes. So Washington, Nevada, Wyoming, South Dakota, Texas, Ohio do not impose corporate income taxes. Obviously, Texas is a huge state for renewable energy development, given the amount of open land in it, but there are several very large states here. And so those states don't have income taxes. They do generally have, most of them, or at least Washington, Texas, and Ohio, which certainly covers most of the people in that set of states have taxes that sort of function in different ways from an income tax, but it serves a somewhat similar role. Washington and Ohio have gross receipts taxes. So rather than, Ohio calls theirs a commercial activity tax, Washington calls theirs a business and occupation tax. But they function similarly into an income tax, but instead of taxing net income, they tax gross receipts. So you don't get credit for expenses for the most part with those taxes. Texas has a franchise tax that works somewhat similarly to a gross receipts tax, but there are, I believe, 4 separate formulas that you can calculate it under. It's sort of a choose your own adventure. You get to pick the formula that minimizes your tax generally. But that is, something to keep in mind. Just because there's not an income tax in the state doesn't mean you're not paying something similar to an income tax. The remaining states that are colored in on this map do have income taxes. They generally function similarly to the federal income tax, as I think I mentioned, and are on net income. But there are exceptions to that, especially as they relate to pass-throughs. New Jersey, for example, which is a relatively small geographic state and therefore, a little less of a concern for most renewable projects, is not being, great site for them. New Jersey, for example, doesn't respect federal pass-through elections. So if you're an S corporation, you need to apply separately for a New Jersey election. A few other states have similar rules, but are generally more lenient about letting you correct it after the fact than New Jersey. So that's an area to keep in mind. Anytime you're looking at going into a new state, you need to see what the rules on pass-throughs are. Make sure you address those. So that's franchise and income tax. It's generally not, the other thing I'll add is most states, it's not just like federal tax. Most states have some level of what is called conformity with federal income tax. So with a few exceptions, and they vary state to state, but how you calculate net income for federal purposes is how you do it for state purposes as well. But of course, in any given state, you need to be aware of any major exceptions. If they don't recognize a certain federal deduction or have different rules for depreciation, that sort of thing. And again, there's just no substitute for checking in every state every time you do a new deal. So that's what I wanted to discuss about income tax. Turning to sales and use tax. So these are related taxes that are sort of designed to capture a whole universe of things, but they are generally separate taxes. And a few states have different technical terms for them, although they will all use sales and use tax colloquially if they have those terms. But sales tax, strictly speaking, is tax on the sale or exchange of an item, so basically tax on the purchase for most purposes. Some states are what's called consumer states versus seller privilege states, and that's just an issue of who the incidence of the tax falls upon. For technical reasons, when you're doing contracts, you'll sometimes want to know, but almost every state requires a seller to collect the tax, regardless of whether it's technically the seller's tax or the customer's tax. Use tax, on the other hand, is a tax on the storage, use, or consumption of items. As relevant here, it really comes up for items purchased out of state and brought into a target state. For example, I can think of at least one client who had potential use tax liabilities because they purchased equipment for one project, did not use it for that project. I think the project never happened, but they'd already purchased the equipment, and then later brought it across state lines to use in a different project. That could theoretically trigger a use tax liability, and we'll talk more about the exemptions in a second. How these taxes are applicable to renewable energy projects is really in two ways. First, primarily in the construction phase, you need to look at the potential sales and use tax on purchase of equipment associated with the project, including solar modules, turbines, mounting equipment, etc. Second, on sales of power. So once you are generating power, there may be sales tax depending on the state associated with that. And I didn't address this here, but I will add that there is third place that sometimes comes up, which is in some states, certain components of management contracts for power plants could be taxable, particularly if the entity charged with management has to supply equipment for repairs and things like that. So that can also come up as well. So most states have a number of exemptions for sales and use tax. Some are electricity specific and some may be renewable specific. Generally, not always, but generally these would be limited to everything before you reach the grid, everything before a step-up transformer. They may or may not include storage equipment, so that's another thing you need to check. And just give you an example, Texas, and I didn't pick that by accident, but exempts specific equipment used to generate electricity, and I've provided the citation there. I didn't reproduce the statute, but they're pretty specific. Most states have what's called a manufacturing exemption, which effectively exempts equipment used to produce products. The applicability to electricity across different states varies. Texas has one of these, but because they have a more specific exemption, it generally doesn't apply to electricity generation. But some states do, so that's another thing to look at. And then there are also resale exemptions. And so this comes up when you're a seller. If you are, the purpose of sales tax is to collect tax at the end use step of a transaction. So if you are selling for resale, for example, if you have an offtake agreement with a public utility that is going to sell to consumers, it's a sale for resale and ordinarily wouldn't be taxed. To document an exemption, you generally need to provide, generally a purchaser who's purchasing for an exempt reason needs to provide a seller with an exemption certificate. Frankly, you go to state comptrollers or Department of Revenue websites, you print it out, you fill it out, sometimes even on $100 million projects, they're done in, ink. It got scribbled on scanned PDFs. And you self-certify and you provide it to the seller. Both parties keep copies for their records, and if anyone is audited about why sales tax wasn't paid, you do that. I will also note that some states have other exemption programs. To give an example, Illinois exempts from sales tax products in certain business development or opportunity type zones. And, there's an application process to participate in that, but it's not a general exemption, but rather is applicable to specific projects. So sales and use tax traps and pitfalls, very briefly, I said Texas wasn't an accident as an example. In 2019, Texas came out with a private letter ruling, which is technically not binding on all taxpayers, but sort of represents the sense of the the comptroller's office as to what the what the correct application of the law is. And they held that fixed racking, tracker racking, and support posts used to hold multiple solar panels that generate electricity for sale are not exempt. There's a lot of consternation about this. A lot of people think it's wrong and will eventually be overturned. There's no real support in the statute or in the cases cited for the idea that single panels versus multiple panels are a point of distinction for tax purposes. But it's significant on a large-scale project in the 3-figure megawatts. That equipment can generate seven-figure sales tax liabilities, and it may be small relative to the whole project, but it's obviously an expense people want to try and minimize. The other place I wanted to bring up is sometimes projects are done and there's a sale leaseback arrangement. Colorado, this came up on a Colorado case for me recently, and so I pulled their rules. But many states tax lease payments. And so in a sale leaseback, if you think about it, the project company acquires equipment, it then sells it to the lessor, and the lessor leases it back. So, you know, is sales tax due on purchase by the project company if it's reselling it? Well, if you know you're going to resell it, you are probably a seller for resale. On the other hand, if you engage in the initial purchase of equipment intending to use it for yourself and then later decide to resell it, you're not, and you could potentially be double taxed. And then is sales tax due on the sale by project company to the lessor? In Colorado, at least the rule is yes if the lease is for less than 3 years, otherwise no. And then is the lease's sales tax due on the lease? And again, it will not surprise you to learn that in Colorado, at least, that general information letter that I cite there indicates that the answer is sort of the inverse. Moving on to property tax. So this is one of the larger potential tax issues. I think we all generally know what property tax is, so I won't spend a lot of our remaining time on the sort of theory of property tax. But there are a number of tax relief mechanisms that may be available depending on your state and locality. Some states you can enter into tax abatement agreements or LAVAs, which are limitations on assessed valuation, with local authorities. Generally, these only apply to increases due to improvements from, and I apologize, there's a typo there, due to improvements from the project. So if you're leasing land and you build a wind turbine on it, it'll only apply to the increase due to the turbine for the valuation. Some states, like Illinois, again, have enterprise zone or redevelopment zone or opportunity zone specific exemptions. I do also briefly want to mention a few states, Georgia and New Mexico most notably, have an industrial revenue bond structure where effectively you can more or less sell the project in sort of a sale leaseback type deal to a governmental body that's exempt from tax, and it can lease it back to you. The lease effectively functions as a payment in lieu of taxes, and you pay the lease rather than tax. Again, there's a few states that offer those. Georgia and New Mexico are the ones I'm most familiar with, but it's something to check out. I did also mention that we would discuss transfer tax. Really the only thing to know there is in some states when you record a real estate transaction, there is a transfer tax. It needs to be looked at. Not every state has one, and there are differing rules for when it applies. A few states also have specialty taxes that apply to renewable energy. For example, Nebraska has a nameplate capacity tax for wind projects, and that is in lieu of certain property taxes. So, you know, again, state by state, the tax schemes may differ slightly. I also very quickly, as I see we're coming up on 1 o'clock, just wanted to point out, I said you always have to do the research. That includes for tax abatement and exemption programs. There's a great resource, it's this database called Desire. It documents state and other tax incentives for renewable energy projects. It does include residential and other consumer level exemptions, so you can have to dig through it a little bit, but it's a great resource. You know, they'll show 60 or 70 that potentially apply in any given state, which is a lot better than starting from scratch. And the other point I wanted to mention is the nice thing about dealing with state and local governments as opposed to federal is you can generally get local officials on the phone and say, hey, we're looking at citing this project here. Can we discuss potential tax incentives? And they're generally happy to help you for very obvious reasons. So that is where my time here ends. And I see, looking at the Q&A, that there were several questions. I think given that we're out of time, we will need to address those via email, but we will get back to people who ask questions. And Chris, do you have a couple of words for people on the way out?
Yes, I just wanted to thank you, everybody, for joining us today, and we hope that the information from Doug, Bob, and myself was helpful to your organization. So as a reminder for all the legal eagles out there, this program has been approved for our legal education credit. And to report the hours, remember to click the CEU icon at the bottom of the screen. And the certificate of attendance, including the course number, will be emailed to you tomorrow. And again, please be sure to complete our survey. And we use this feedback to plan our future programs that may be applicable to your business needs. So this concludes our webinar. And again, thank you all for attending.